Hello everybody, it's Steve Moon from the Mortgage Center, Sunshine Financial in Cambridge, Ontario. Put together this video to talk a little bit about the new requirements from the feds for the stress test for mortgages in Canada. We're going to start off by talking about who's been affected by these new measures. So first of all, it's about the down payment really. So anybody who is putting less than 20% down is going to be affected by these new rules. So pay attention if that is the case for you. So what we're going to do to figure out how that does affect your buying power, we're first going to look at calculating a monthly payment. So if you have a mortgage of say $400,000, you put a minimum monthly payment, down payment rather, of $20,000. We're not going to talk anything about legal fees, land transfer tax, or statement adjustment, trust account stuff. We're just going to talk about the mortgage itself. So 400 minus 20 gives us a purchase less down payment of $380,000 required to be financed. Then we have to add to that our default insurance, so that'd be your CMHC, Genworth, or Canada Guarantee amount of $13,680 to give us a total principal amount to be financed of $393,680. So what we're going to do is take that and apply a 5-year fixed rate to that of, using an arbitrary number of 2.49% of today's market, and gives us a monthly principal and interest of $1,764.13. Then what we're going to do is apply a stress test. Now the stress test is applying a higher mortgage or interest rate rather, so for example the Bank of Canada post rate of 4.64 to that mortgage to see if it can be afforded, the affordability of that at that higher rate. So our new what if amount is going to be a value of $21,2960. So we're going to take that and apply that into the way the banks use for calculating what you're going to qualify for. So first thing we'll look at is capacity. So the banks use a couple different key indicators. So the first one is the gross debt service ratio, or the GDS. So part of that is looking at the monthly principal and interest payments, adding on the municipal property tax, adding on the heating bill to give us our total gross monthly payments before consumer debt. The second thing then we look at is the total debt service ratio, or TDS. The TDS basically adds the gross monthly payments before consumer debts and adds those consumer debts. So you look at your Leon's card, your Visas, your MasterCards, your loans, your lines of credit, add that all up and add that to your gross monthly payments to get the total amount with your TDS. So if we look at our actual payments first of $1,764.13, we add in, say if property taxes are $4,000 a year of $350, we add in a heating bill of say $125 a month. It comes out with $229.13 as our gross monthly payments before debt. CMHC has come up with a guideline of 35% as a service ratio, and so we're going to take that, we're going to take our gross monthly payments and divide it by the GDS percentage, which is going to give us an income of $76,770. Now that amount is if you didn't have any debts outside of the mortgage. That would be the income required under the old method to get a $400,000 mortgage. However, in Canada, the average debt is about $21,000, so we would need to add $650 arbitrarily to that amount to come up with $28,8913 of total monthly payments. The TDS number we use is 42%, so we take our total payments, we divide it by the TDS of 42%, which is on the guidelines, which would give us the $82,550 under the old method for income required to make a $400,000 purchase. So we've got we obviously would use the higher of the two when we look at this as a total picture to afford this property. Now, looking at the next method, which is the what-if payments. So with the what-if payments, we're going to look at that last number, which was the amount calculated against the benchmark. The posted rate would be $29,2960, adding in the $350, the $125, which would then give us the $26,0460 as our gross monthly payments before debts. So we take that, we divide it by the 35% to give us $89,300 as the income required if there was no other debts. However, in this situation, we're assessing a $650 monthly debt obligation, which would mean that we would need a $92,988 income based on the 42% debt service ratio number. We would then pick the highest of the two as what would be required for this property. So the 9288 is 13% higher more than the what was required elsewhere. So, you know, that's a big change. So what we look is the big picture on this. So if we look at the average or the median rather household income based on 2004 StatsCan numbers, it's $84,380 for average household, or median household income rather. The average single detached family home in Kitchener is $487,050. So if we apply a 5% down payment again using the same methodology, that'd be $24,350 approximately is the down payment. We use a $375 a month monthly property tax, $125 a month heating bill, and we come up with, using again that 2.49 rather, we come up with a monthly payment of $2148.05 as our actual for the monthly payment. So that's using our actual, but under the new guidelines we have to use our what if. So in other words, we're going to use the Canada Post rate of the 4.64, and we're going to come up with a what if value of $2702.66. Then we need to add our consumer debts, which is that $650 a month, which is the average, to come up with a total principal, interest, tax, heating, and monthly debt payments of the $3852.64. So in order to service this, the total household income required would be $110,075. So we can see is definitely a significant increase in requirement. It's actually $27,000 over what the income is, so a 33% raise is what's required for everybody. So when we look at the average income, we then say, okay, well, let's back this up and say, well, what can the average Canadian afford? So if we use that $84,380 as the average income, we can look at a purchase price based on GDS. In other words, somebody who doesn't have debt other than the mortgage. Under the new method, they would be able to make a purchase of $355,000. Under the old method, with everything else being considered equal, that would be a payment or the purchase amount of $450,000, so almost $100,000 different. Using that $650 a month average for debt based on GDS rather, under the new method, that purchase then would be changed. It would be a purchase price of $325,000, whereas under the old method, the purchase would be $410,000 for the approval. So final it's looking on this, we're looking at the effect basically in the multiple offer scenario, because they seem pretty evident. You need to know the caps that your clients have or yourself has. Second thing is buying within your guideline, within your means is really important. And then the other thing is having a fully documented deal for the approval for your pre-approval, because then it makes it a lot more effective for you to go out shopping. So thank you very much for watching this video. Please share it and look forward